For those of you that joined us for the BAFT FCC live workshop that we organized at the tail of the most recent BAFT global annual meeting in May in Washington, D.C., you might recall that we had a very similar panel during that session. And as we were getting ready for today's virtual workshop, we had discussions around receiving a lot of positive feedback following that session, and also realizing so many things continue to happen, so much evolution in the financial crime compliance space. We have decided to bring back our speakers and talk about everything that has been happening since we since we discussed this topic last time. And just to support that, I was at another event recently, and I heard one of the U.S. government treasury speakers say, and I quote, "What a decade these past few months have been." And that just demonstrates that truly just so many changes, so much is happening in the financial crime space in the US as well as globally, as you heard. So with further ado, let me welcome our wonderful speakers. First, I would like to welcome Magali Langhorne, Managing Director and my fellow partner at Deloitte Financial Crime Practice. She's also a former officer, Bank Secrecy Act, Anti-Money Laundering Supervision at the Federal Reserve Bank of New York. She brings nearly 20 years of industry experience and advises her clients on complex BSA/AML compliance matters, regulatory expectations, large-scale remediations, and leading practices. Prior to joining Deloitte, she served as the BSA/AML officer at the Fed, as I've already mentioned, part of their supervisory group, where she supervised examinations of more than 180 banks and remediations of enforcement actions. Thank you, Magali, for joining us. In addition to Magali, I would also like to welcome Matt Proberstein. He's the head of institutional cash management, North America, head of institutional cash and trade, engagement controls, and risk oversight. He has been with Deutsche Bank for the past 4 years, shaping their financial crime compliance program and strategy in various leadership roles. He's also a board member at the International Bankers Association of California, an advisory council member at Lawyers Without Borders. Previously, he held various leadership positions at Standard Chartered Bank, Barclays, SocGen, ABN AMRO, Mizuho, Citibank, and JP Morgan. So certainly bringing in a lot of experience from across the industry. So welcome. Thank you for joining us today. As our first topic for today's panel, I would like us to talk a little bit about regulatory enforcement and examination environment currently in the US. And Magali, I would like to open with you. Given the recent messaging from the new administration around easiness of examination environment, should we be expecting a lighter touch from regulators in terms of enforcement and examination outcomes? Examples we have heard around thresholds for materiality and thresholds for MRAs, MRIAs, etc.
So first of all, thank you so much, Miriam, for having me, and to BAFT as well. It's always such a pleasure to share either a physical or a virtual stage with you. And Matt, my dear friend and industry colleague, and Miriam, obviously my Deloitte colleague. So yes, there has been a lot of chatter, I think, around should we expect any changes from a supervisory perspective regarding the overall examination approach. And I wouldn't do my former self justice if I did not state the obvious and just remind folks that compliance with BSA, AML laws, rules, and regulations still remain, right? There are statutory requirements that banks have to comply with from a legal perspective in terms of BSA, AML program requirements. And then there are also mandated legal requirements to conduct said examinations for supervised institutions. So that has not changed. I think there has been obviously a slew of announcements and guidance since the senior leadership of various regulators have been, appointed and confirmed, both at, for example, the OCC and the Federal Reserve, that indicate a very concerted and proactive approach to reforming BSA, AML, and the overall, I believe, the supervisory approach. And I should preface, these are obviously my comments, my opinions, and not those of my former employer. That being said, so we have to still balance the need to comply with statutory requirements, but also in light of these very real announcements by supervisory officials in this space. I will say that based on my thinking and what we've seen in industry, I think there is a concerted approach to ensure that the supervisory approach and regulation from an AML perspective emphasizes the risk-based effectiveness of a program in line with priorities set forth by the administration. What does that look like on the ground for examiners and during the examination process? I can only lean on my own personal experience as an examiner during the period between 2016 and 2020, whereby I think it's safe to say that there was a concerted effort to ensure that obviously supervisory findings are tied to statutory requirements, and we look at the scope of an examination from a risk-based perspective. I think you'll continue to see that trend, and the testing will still be there from a program perspective because there are legal requirements, like I've been saying. But I do expect that you'll see an incorporation of the various statements that have been made over the last couple of months by the various supervisory authorities in the overall approach for determining whether or not the programs are adequate based on the risk profile of the institution. That may impact particular assignments of materiality for various issues. You may or may not have been seeing that in your own institutions recently. And that is indicative, most likely, of this overall effort to ensure, and I think you heard the comments in FATF, Miriam, so that's very timely, that the supervisory approach moves away from compliance for compliance sake, but towards an overview, an assessment of a program's effectiveness vis-a-vis the priorities set forth in guidance from the current administration.
Thank you, Magali. Some really helpful insights into what we can expect from the exams and enforcement going forward. Matt, let me turn to you. What, if any, changes to this regulatory approach that Magali just described have you already observed at your institution, and what do you anticipate in the future?
So, Miriam, first I want to say thank you to you, BAFT, and Magali. It's always an honor and a pleasure to share the stage with you, and I'm thankful for you to invite me back to this one more time. So look, what Magali said is spot on. I mean, over the last few decades, we've seen shifts in examination approach, enforcement activities. And while today my general experience is that examinations are more coordinated than ever before, there isn't enough time or resource to really dig into an institution and understand it from end to end in just an annual examination. There's enormous document requests that take place, diagnostic checks, sample reviews, some questions, interviews, testing, but overall the depth and time allotted during an examination alone just isn't enough time to really assess an institution end to end. So to really confirm if an institution is operating safely and soundly, the current evolved approach to engagement needs to continue, in my view, and even evolve. This is including dynamic and more frequent discussions, updates content submissions that are simple and easily understood. There's got to be continuous oversight from key staff, from banks, and contact with key regulators. Even depending on different topics, the regulator can vary, but the work has to take place to stay engaged. The conversations need not shy away from difficult discussions or complex issues that haven't been solved yet. The key is to show awareness, next steps, and plans to really solve the problem. So the way forward has to take this principle of continuous oversight, in my view, and also add technology to enable everyone involved to search for key points, summarize outcomes, and point to potential deficiencies. If this system can evolve in a real-time approach without the need for reliance of people to report, escalate, and everyone gets the same type of indicator and can then engage, that's really the next generation of examination, in my view. But until this happens, banks need to be on the front foot. We need to continuously apply critical governance, work in partnership to ensure full transparency. We need to escalate with speed, produce simplified content. And if we can find this ongoing continuous rhythm, it's going to be different for every bank, every examiner. But if they can establish a consistent rhythm and enable this type of ongoing engagement, then I think we'll make the financial system safer and more inclusive with that type of partnership.
Thank you, Matt. Super helpful. Let me stay with you. In addition to the changes in the regulatory approach that we just discussed, I know that the banks are under a lot of pressure, right? Reduce costs, rationalize staffing, do more with less. The recent guidance from FinCEN, specifically the SAR FAQs that were published just last month, they further support this approach. How does this impact banking industry's approach to financial crime compliance?
So I love this topic because in my view, it's one of the greatest industry shifts I've seen in about 20 years in doing this, especially on the topic of suspicious activity filing, effectiveness, and investigations. So banks, like any business, are constantly measuring costs, income ratios, cost of equity to serve clients, and ultimately shareholder value add to customers and shareholders. When it comes to financial crime compliance, costs are typically the largest. And they typically go side by side as the largest cost with technology and infrastructure. In the financial crime space, the greatest cost typically comes from human capacity required to support the investigation process, SAR filing, transaction monitoring approach, and more. So the latest SAR FAQ finally takes stock of noise in the system, lack of prioritization, and is aiming to stop process where typically 99% of the work leads to false positive or defensive filings. And so, for example, structuring-based SARs linked to wire transfers make sense in countries where there are FX limitations and people are looking to bypass those limitations and the related reporting requirements. Some people in the industry will say that the rule is aiming at the structuring mindset linked to cash deposits and withdrawal reporting. But the reality is that most wire transfers, once structured and organized in a certain fashion, are done so to pay invoices, projects, and they have an associated schedule of payment for product or services rendered. And if they have a bank account on both sides of the transaction, it typically means that everyone's participating through the full KYC process of a bank that's got correspondent banking access. But if you're an AML investigator and you're looking to tell the difference using public resources or limited tools, it may be really difficult to understand what the difference is between structured transactions and whether they were organized for some type of financial crime reason, or if they're really legitimate payments. And so then a SAR is filed. And imagine this happening millions of times a year all over the world. And then the noise that the system then takes in and the impact to law enforcement, just like data storage and all these other types of linked like functionalities, it really becomes an impossible situation. Similarly, on the continuous SAR reporting front, if law enforcement hasn't followed up with a bank for years, or sometimes banks have this kind of 3-strike interdiction rule, if there's no indication that the SAR we filed is leading to something that's important or necessary to continue filing on, then banks will likely move away from their client because they don't want to continue reporting SARs, and then they're exiting and impacting good people and businesses, leading to de-risking. So changes like these are really helpful, not just for banks to calibrate their approach and costs, but more so it's a win for law enforcement, security, and I think industry effectiveness.
Thank
So
you.
Miriam,
Sorry, go ahead,
Miriam,
Magali.
yeah, if I can follow up that. And I'm going to say, Matt, I am 100% sympathetic to the, you know, the level of complexity and burden that you just outlined. I think that the you know, the recent announcements, including the FAQs, what's really important to understand is that those do not change the existing legal requirements, right? What they do is provide helpful guidance as to how a firm can comply with said requirements, right, from a risk-based approach. And so I think if I were advising a client today on how to interpret those and the expectations that I would expect an examiner to come in on, you know, the first day and start sampling SARS and the transaction monitoring process and alerts and cases and investigations. And I think it's also mentioned in the FAQs, is from a risk-based perspective, and ensure that the documentation that is provided and retained in terms around the transaction monitoring process clearly supports whatever decision or conclusion it has made for reporting purposes, right? How the institution wants to do that from a risk-based perspective is within their own purview, especially for the no-SAR determinations, I think. And that is exactly what I would expect an examiner to still come in and review for adequacy, but emphasizing the risk-based approach there. I do think that if we take a step back, and these type of FAQs and advisories and guidance and public statements made by supervisors are there to reinforce the commitment to supervisory reform from a BSA perspective, and I think that is very important. And it gives the firms and institutions, you know, guidance in terms of how best to risk-base their programs, and it also provides that type of guidance to examiners as well. So I just wanted to emphasize that.
No, great advice, and I know, Magali, that you advise many C-suite level executives on how to interpret some of these recent guidance documents that are coming out, and how that should change or not in terms of how they are approaching their financial crime programs, both short-term and long-term. Maybe next we switch to and talk about some of other new administration priorities that we are seeing. And Magali, maybe I stay with you for a little bit. Before we go deep dive on any of the specific priorities, in general terms, how should banks think about these evolving AML fin crime priorities, given the speed and volume that we are seeing from the new administration?
Yeah, thanks, Miriam. So I think just, you know, going back and again, my own personal opinion, I don't think it is an unfair characterization, right, or takeaway that perhaps historical approaches may have, you know, given the perception that supervision was for, you know, compliance for compliance sake, right? And I do think potentially it is a fair takeaway that there was a disconnect between supervision of AML compliance and the overall approach vis-a-vis national priorities and law enforcement priorities. And what I think we are seeing in terms of the broader BSA AML reform posture is an attempt to reconcile those two bodies of thought. And I think that is extremely helpful, right? So if you see the emphasis on the national priorities, administration priorities, that lends itself to incorporation into an AML program. And by the way, most firms with mature AML programs have already incorporated these typologies to a certain extent, right? And now it's the supervisory approach that should follow from a testing perspective, an examination perspective, ensure that the program is an effective, has an effective control environment to mitigate the typologies and the risks identified in those particular priorities. So, and Miriam, you and I have talked about this before, obviously, should be included in the risk assessment, right? Those typologies should already be in your transaction monitoring controls from a coverage assessment perspective. And I think the ongoing evolution to reconcile, compliance sake versus law enforcement and national priorities, we're now seeing that trend progressing positively, in my opinion. I would love to hear Matt's perspective on that.
Yeah.
Go ahead, Matt.
Yeah. Well, look, I mean, Magali said it. If you're a bank with a financial crime program that's robust and established, you would have weaved in the priorities quite a while ago. From my perspective and kind of following the corresponding banking space and the payment space, there are, of course, several priorities, but I think the U.S. is aiming in a big way at disrupting narcotics trafficking. And so we're seeing this manifest in 311 designations of Mexican FIs, military efforts to disrupt trafficking by stopping shipment, sanctions against the Colombian president and his family under the counter-narcotics related authorities, conflict with Venezuela, labeling their president and his supporters as organized criminals involved in drug trafficking. So this version of war on drugs, and it's really the most public in recent times, and banks need to, I think, ensure that they play their part in supporting the government efforts, aiming at all the priorities. But I think at the moment, this is the one that's like keeping banks the busiest. I think they can do this in particular, aiming at this narcotics trafficking, human trafficking priority by ensuring that they're paying attention to high-risk corridors, looking at entities operating on U.S. borders. If it doesn't make sense, they really should stop it and investigate. They need to understand logistics companies, shipping company practices. And if they see something serious, don't just file a SAR. Really call FinCEN, call your local FBI, your law enforcement contacts, and make sure the speed is involved in sharing the intelligence that a bank is seeing. So I think Magali's spot on. The risk assessment needs to include all the priorities. And I just think that this is one that's peaking at the moment. Cyber enabled fraud and crime has been peaking for a while, but this is the one that I think is front and center for at least banks offering correspondent banking services.
And proactively demonstrate that to examiners, right? To Matt's point, if you're doing that, if you have already incorporated the priorities and the focus of these various guidance and advisories and announcements, it can only benefit you when the time comes for an AML examination, right? To proactively educate your examiners on your efforts to do exactly that.
If I could weave in one more point, just building on what Magali said earlier, the SAR FAQ, documenting and understanding how you can leverage resources and repivot a program. This is really timely because if banks are doing this correctly, they can repivot and document that they are refocusing those resources and efforts on the priorities and which priorities and why. This should all kind of intertwine.
Very, very, very good point. And around that interconnectivity, right? It's not just your risk assessment, it's your entire AML financial crime program that should be reflecting the priorities. One of the things, and I will go back to the conversations with the FedF I had earlier this week. One of the other things, obviously, operating in the U.S. administration priority is very important for global institutions, right? There are obviously priorities reflected in other jurisdictions. FedF just published guidelines on NRA's national risk assessments and specifically highlighting areas of threat to national security that should be incorporated into national risk assessment level. And we just talked about how important it is for institutions to also consider these threats as part of their institutional or enterprise risk assessment, right? So kind of taking tips, not just from the institutional level type of administration priorities, but also from the national level. Matt, maybe for the next topic, I would like us to double click on crypto and digital assets, since we are talking about the new administration priorities. We know that Deutsche Bank is very active in the space, given the Genius Act that just came out this July, thereby establishing the first comprehensive federal framework for regulating payment stablecoins. What are some of the steps that the banks are taking as a result of the Genius Act? And how is this contributing to increasing involvement of banks with digital assets?
So Miriam, thanks for this. And I want to also take a second just to describe kind of the global perception that we're seeing linked to the Genius Act. So it's creating a framework to enable institutions to create and support stable coins by linking the digital asset to USD and allowing the coin to be backed by liquid reserves. The US is really leading in this space by creating the framework, and by doing so, it's securing US dollar global dominance by ensuring the coin is linked to US dollar. In parallel, this is creating quite a global monetary dilemma. We're seeing countries try to figure out, are they going to adopt stablecoin? Are they going to rely on the US version of it? We're seeing that the European Central Bank is fast tracking digital euro. We're seeing China exploring offshore yuan-backed digital currency. And so really the advantage of this Genius Act is that it's giving the world a US-backed regulatory framework, ensuring that certain entities can issue stable coins under supervised conditions, including providing and proving existence of liquidity to the coins, having a compliance program that meets the tough BSA/AML standards that have been set out for the last few years. It includes audits, reporting obligations, and more. The framework is also really timely as it's creating a payment capability and product that's going to rival traditional payment product and rails. It's evolving the industry from your traditional wire transfer to coin transfer. But the implementation won't be so straightforward in my view. I think there are going to be fees, deposit pressures, compliance controls, and things like this that need to be mapped out over time. And of course, partners like yourself and Magali, I think, are primed to support institutions in doing this. Of course, non-bank issuers of stablecoin really don't like this, right? Because it supports big bank entry into a market typically dominated by fintech type of entities. And while banks are usually partnering with experience on more agile entities to enable market share traction, I can only imagine that the market cap surged from about 5 billion in 2020 to close to 300 billion in 2025 is creating room for everyone to play. So as the act is moving forward towards full implementation by January 2027, we're expecting greater emergence of traditional banks in a space. Some large bank spin-offs might create fintech vibes and those type of entities to zoom in and really focus in on stablecoin. We'll probably see consolidation of players in the space today with those who have the experience in offering these entities where larger banks want to come in and leverage that experience. And by the way, my recommendation is to always partner. It takes a lot of investment, a lot of time. If you don't have the experience and you are starting something fresh like this with speed needed to implement because the market is moving fast, banks are exploring all these different variations. Should they do it themselves? Should they partner with existing providers? Should they consolidate? If you think about the type of stable coin, how will one bank stablecoin differentiate itself from another bank stablecoin? That would be on the strength of the bank and its network. And so all these considerations are in flight, but one thing's for sure, everyone's racing to that kind of finish line to really get up and running in this space.
And Miriam, I think it's I think it's important just to add, I would be doing my regulatory friends a disservice if I didn't say this, but just like any other product or service or customer base or expansion, right? From a risk-based perspective, that's higher risk in nature, that an institution is expanding or exploring, right? It's very, very important to demonstrate. It just so happens here we're talking about digital assets, but it's very important to demonstrate an adequate control environment to absorb that risk and mitigate it from a tailored perspective. And I think that any institution venturing into this space, and I know Matt, you have a lot of experience with this, has to demonstrate that body of work has been done, that it's tailored to the risk associated with it, and proactively communicates right back to their examiners and the exam team the effort made, the controls that are in place to mitigate said risk, because obviously it will come under scrutiny for exam purposes.
Awesome. Some really helpful tips there. Matt, I think you will be also getting a lot of calls and questions with regards to crypto and digital assets and the Genius Act. Maybe one more area of administration priorities that I would like us to discuss and analyze a little bit more, specifically relating to global sanctions. I mean, we are seeing such rapid changes in terms of geopolitics and new sanctions coming out, changes to the existing sanctions programs. Matt, maybe I start with you. How are banks reacting to some of these recent updates? I mean, we've seen the 180-day waiver for Syria, the 1-year exemption to Hungary for purchasing Russian oil and gas, blacklisting of some of the Russian oil companies in relation to Ukraine invasion, new sanctions related to Iran-backed militia groups. How do banks keep their sanctions program agile enough to be reactive to some of these rapid changes?
So like it's a thanks for this question. It's an extremely, I think, complex topic. Banks are being cautious. I mean, that's the best way I can describe it. They're being super cautious, super conservative. I think despite the waivers and exemptions, banks are staying away from many of these topics. You know, even though payments to or from Russia are not fully sanctioned, banks just stop making payments to or from Russia. In relation to Syria, everyone's exploring, no one's going first. No one's running to re-enter the market despite lots of exploration, government agencies discussing on how to support this. We've got a lot of interest in doing this, but knowing who's who on the ground and understanding political links, ties to former designated entities or individuals, it's really complex. Unless you can get on the ground and really assess, understand what's going on, banks are really being cautious. And I haven't seen really anyone enter as the first large international bank. The investment and risk management in some of these areas is just not also commensurate with the potential reward. I think the consequence and likelihood of getting something wrong is very high. That's why banks stop making payments to from Russia. The amount of circumvention, the amount of secondary sanction consideration going on, it's really, really difficult. So what can banks do? Of course, follow the rules, follow the lists, cooperate with authorities as there's a lot of activity going on in the background, but also be proactive. So at Deutsche Bank, we have something that we call a sanctions desk. And this is a unit, a team of people who are proactively monitoring every month, in addition to all their other controls, all payments using certain triggers and thresholds and settings to see if there's a circumvention attempt, if there is some type of secondary sanction link that's just too high for us. And then we're taking action to mitigate by not processing transactions going forward. Sometimes we're learning different nuances and we're seeing product manifesting in or originating in a country that doesn't belong there. And these are all the kind of red flags or indicators that hint of sanction circumvention. So banks need to continue doing, I think, the standard list management, transaction screening, onboarding controls, but they also need to, I think, be a little bit more proactive and aim at corridors, look for certain trends and themes, and have dedicated resource to what can come next.
Thank you. Maybe for the last few minutes, I would like us to focus on positive, the regulatory relief and innovation that everybody's talking about. Magali, given some of the recent executive orders and messaging around unleashing the financial sector, liberalization of regulatory environment, what are some of the things that FinCEN and the federal banking agencies could do to improve immediate flexibility and agility in FCC programs?
Yeah. So I think I'll go back to how we started at the top of the call, Miriam. I think that I can hear my regular friends in my ear. There are still legal requirements to comply with, right? That being said, I think that now is the time to ensure that programs are risk-based and effective, and also taking advantage of the ability or the current environment and the appetite to innovate where it makes sense, right? To allocate, I think Matt said it well a couple minutes ago, to allocate resources accordingly on a risk-based perspective. And also important to ensure that you take your supervisor, examiner along the way from every step of the process. Since I think there is that appetite, and we are in that current environment at this time, it's very, very important to communicate that early and often. You know, the interagency statements released all the way back in 2018 around innovation further support, right, that progressive evolution around this notion of appetite and flexibility. You know, that being said, you still have to comply with legal requirements, and you have to do it responsibly. Document the effectiveness, document the control environment. But I can't emphasize enough for our friends on the call is to make sure that you communicate proactively early and often these type of evolution steps in your program to your supervisors. You don't want to inform your examiners of any changes in your control environment or in this space and innovation the first day of an examination. That will lead to quite a number of conversations that could have been had along the way, right? Mm-hmm. And you decrease the risk of surprise, right?
Yeah, for sure. Communicate often. Matt, from bankers' perspective, what should we expect in terms of innovation, leveraging AI? Should we expect the floodgates to open from the bank's perspective, given the changes in the regulatory environment?
So hey, I love this question because I'm a banker today, but I'm always a financial crime fighter. So as a business leader, banker, financial crime fighter, this is always on my mind. I'm always thinking about how do we drive forward business while enabling safe access, reach, and inclusion? How do we ensure we promote financial literacy to those who need it while not making bad decisions and lose control over who's using our products? And underpinning this consideration is that we need to partner with all involved, including law enforcement, regulators, experts like you and Magali, industry partners, and more. And my conclusion is that we cannot wait. We cannot wait for others, and we really have to take control of the narrative and our future so that we enable the type of business that we want to drive forward. So our plans, for example, at Deutsche Bank have been based on reinforcing our AFC controls, our anti-financial crime controls, our capabilities, our capacities, but also reinforcing our business controls and embedding our culture of risk management side by side with revenue and deep within our strategy to ensure that we're doing business with the right clients, taking on the right deals, entering the right locations. We're also exploring alternative rails. So in case payment systems shift significantly to blockchain, stablecoin, localized settlement networks, or in case the financial system is attacked, we really want to have the resilience to be able to respond and promote access, through like the most turbulent times. So it's on our mind, and planning for the future is really the only way to survive, I think, in the banking industry.
Awesome. Thank you so much for sharing that. We only have a few minutes left. Maybe some final closing remarks. If you had to predict the landscape of financial crime 1, 2, 3 years from now, what should we plan for? Is it going to be political? Is it criminal? Is it COVID? Take out your crystal ball. Magali, would you like to start?
You know, if you had asked me this question this time last year, I don't think I could have predicted the fast pace of change in the last couple of months. So I'm not too good at predictions. But I think it's safe to say, and again, my personal opinion, that the current commitment to reform from a BSA perspective and from a supervisory perspective, which, by the way, has been, articulated by industry for a very long time, right? So this is not an issue of first impression, but I think you see it solidified, right, in terms of actual announcements and action from a regulatory perspective to an extent that we've not seen in the past will continue. I don't expect that to go away anytime soon. I do expect, but change takes time, right? And so from a regulatory perspective, I do expect to see continued modification and pivoting and over the overall supervisory approach vis-a-vis the recent announcements and guidance and regulatory environment that we've seen over the last couple of months. And for my financial institution friends on the line, if you're saying, well, Magley's saying this, but I haven't seen it in my recent exams. Change, it takes time, and I do believe that it should, become more apparent if it hasn't already at your institutions, that the various reform posture will be incorporated in the overall examination approach. So I'll sum it up by saying I think I expect this evolution to continue. I expect the reform process to continue. You'll see or hear more announcements from regulators, and firms should incorporate those announcements into their programs and evidence that when it comes to examination time.
Thank you, Magali. Matt, what is your vision?
So, I think we tried to answer this a few months back while we were in DC. And I think my answer today is a little bit different than my answer previously, so don't hold me to this. I think the financial crime compliance programs of the world are very much linked to what's going on in the world. So I'm just hopeful that the conflict between Russia and Ukraine stops, that we see conflict resolved in the Middle East and Iran just for a long period of time, that narco trafficking efforts currently underway disrupt operations so much that cartels and human trafficking are fully disrupted. Unfortunately, I think about what I said previously and what's the case going forward and how long this has all been going on. I just don't think it's going to change soon. I think it's probably going to escalate a bit more before it can get worse or before it can get better. And so the need to brace for the worst is always on my mind, ensuring that banks have the right technology to enable their efforts. Regulators are evolving their approach and continuously, testing and ensuring that banks meet the mark. I think creating maximum partnerships to be the most effective is critical, and then investing in people with the right skills to ensure sustained effectiveness is going to be the name of the game. So this is what I'm hopeful, but I'm preparing for the worst.
Thank you. Really, really appreciate that. I think we are right at the top of the hour. Really appreciate both of you, Magali, Matt. Thank you so much for joining us this morning. I think getting views and expert perspectives, both in terms of ex-Federal Reserve Bank examiner and a banking financial crime professional leader, couldn't open this webinar in a better way. So thank you so much for joining us.